Today I'm going to break down the 7 most common questions I get about DSCR loans. If you think about buying investment properties, or you've been told you don't qualify because of your income, this is something you need to understand, because the loan works completely differently than what most people are used to. Byron here. If you like straight to the point content like this, hit the like button, subscribe, and turn on notifications so you don't miss the next one. Question 1. What even is a DSCR loan? I get this one all the time, and honestly, most people overcomplicate it. A DSCR loan is just a loan where you qualify based on the property's income instead of your own personal income. That's it. Instead of a lender digging through your tax returns, questioning your write-offs, or trying to figure out what you actually make, they look at the property and ask, does this make enough money to pay for itself? If the answer is yes, you've got a deal. Here's a simple breakdown. Think of it like this. A normal loan is based on you. A DSCR loan is based on the deal. So if you've got a strong property, you don't need a perfect income situation. Question 2. Do I need to show tax returns or W-2s? The short answer? No. Because for a lot of investors, their tax returns actually work against them. They write things off, they reduce their taxable income, and now on paper, it looks like they make less than they actually do. Banks hate that. They'll say you don't qualify. But with a DSCR loan, none of that matters. No tax returns, no W-2s, and no digging through your income. The property is what qualifies. I've seen this a ton. Someone owns a business, makes great money, but writes a lot off. They go to a bank says no. Same person, same deal, we structure it as a DSCR loan. Proved. Nothing changes except how we looked at the deal. That's the difference. Question 3. Can I use Airbnb or short-term rental income? This is a big one right now. And the answer is yes, but there's a right way to do it. You can't just say, I think I make this much on Airbnb. Lenders need data. That usually comes from one of 2 places, either an appraisal with a rental analysis or short-term rental data tools that estimate income based on the market. So if you're buying in an area that supports Airbnbs and the number makes sense, you can absolutely use the projected income to qualify. And here's an important thing to note. This is where working with the right lender matters. Some lenders don't even understand short-term rentals. Some won't allow it. Others specialize in it. That's the difference between getting approved and getting shut down. Question 4. How much do I need for a down payment? Most of the time, you're looking at somewhere between 15% and 25% down. Where you fall in that range depends on a few things. Your credit score, the property type, and your experience as an investor. Stronger profile equals lower down payment. Weaker profile, you're putting down a little more. Here's a quick reality check. This is not a 3% down, first-time buyer type. This is for investors. But you're getting flexibility in exchange for the down payment. No income docs, more property options, and ability to scale. That trade-off is worth a lot for a lot of people. Question 5. Are the rates higher than traditional loans? Yes, they are. And I'm not going to sugarcoat that. Rates on DSCR loans are usually higher than conventional loans. Why? Because the lender is taking on more risk. They're not verifying your income. They're relying on the property. But here's what people miss. Although the rates are slightly higher, you can simply offset that with higher rents. That's what matters. I've seen people pass on great deals because they were too focused on rate. And I've seen others build entire portfolios using DSCR loans because they are focused on cash flow. Question 6. Can I close in an LLC instead of my personal name? Yes, this is one of the biggest advantages. Most traditional loans make you close in your personal name. DSCR loans, you can close directly in an LLC. That means cleaner structure, separation between you and the property, and it's easier to scale as you grow. And here's why investors care. If you're planning on owning multiple properties, you don't want everything tied to you personally. This gives you flexibility on how you structure your portfolio. Last but not least, question 7. Is there a limit to how many properties I can have? This is where DSCR loans really stand out. There's usually no set limit. Compared to traditional financing, most banks cap you at around 10 financed properties. With DSCR, you can keep going. As long as the deals make sense, you can continue to build. This is how investors go from 1 property to 3 to 10 to 20 plus. They're not relying on their personal income. They're relying on the performance of each property. That's a completely different game. So let's bring this all together. DSCR loans are not for everyone, but if you're an investor or you're trying to become one, this is one of the most powerful tools available because it removes the biggest bottleneck most people have, their income. If you're thinking about buying an investment property or want to see if a DSCR loan would work for you or your situation, reach out to me directly.